today we are going to walk through a really powerful framework called the 10-minute investment test. It's a simple way to help you answer that one huge question every single investor faces, right? It's the classic problem. You log into your account and you're just hit with this wall of tickers, thousands of them. It is completely overwhelming. So how do you even start to find the real gems in all that noise without, spending the next 6 months of your life analyzing every single one? Where do you begin? Well, the good news is there is a way, and that's what we're going to cover. Welcome to this video on investment basics. We're going to give you a framework, a really powerful filter that will help you cut through all that clutter quickly and efficiently. And hey, make sure you stick around for the whole thing. This isn't just a simple checklist I'm going to give you. The real magic is how these steps all come together to build a disciplined, repeatable strategy. And we're going to cover that in detail in our conclusion. So here's what we've got on tap. We'll start with the problem itself. Then we'll dive right into the test. We're going to cover quality, financials, and risk. After that, we'll talk about what happens next, and then we'll wrap it all up with what I think is the most important part, how this whole thing puts you on the path to true investment discipline. All right, first things first, let's really dig into that core problem, the overwhelming choice. To have any chance of success, you absolutely need a framework for focus, something that makes sure your valuable time is spent only on the most promising ideas. And that solution is what we're calling the 10-minute test. Now, what's so cool about this is just how efficient it is. Look, the goal here is not to find a stock to buy in 10 minutes. No way. The goal is to figure out if a company is even worth another minute of your time. By asking just a few sharp questions, you can probably toss out at least half of the stocks you see, and that's going to save you countless hours of research on companies that were never going anywhere. So let's jump right into the test. The very first thing we're going to do is apply a quality filter. This is all about immediately weeding out the obvious junk that's out there. Step one is just filtering out the riskiest of the risky. So we're talking about avoiding tiny companies, the ones with minuscule market caps. We're also steering clear of stocks on the pink sheets. Those are super lightly regulated. You also want to avoid foreign companies that don't file their financial reports with the SEC. And you want to be really careful with recent IPOs. Think about it. Why do companies go public? They do it when they think they can get the absolute highest price from the market, which almost never makes them a bargain for you. Okay, here it is. This is a deceptively simple question that will save you so much trouble. Has this company ever actually made an operating profit? And I'm not talking about some one-time gain from selling a building. I mean, did they make a profit from their actual core business? It sounds so obvious, right? But you'd be shocked how many exciting story stocks have never actually proven they can earn a buck. And this quote just says it all, doesn't it? Putting your money into a company that is consistently losing money is a huge gamble. It's basically a bet. Sure, they might have some world-changing product in the works, but the odds are seriously stacked against you. So unless you're okay with lottery ticket level risk, it's usually best to just take a pass. All right, next up, if a company has made it this far, we need to pop the hood and check its financial engine. A great story is one thing, but is the business itself actually healthy? Let's get into the numbers. And the first metric we're going to look at is return on equity, or ROE. This basically tells you how good the management team is at using the company's resources to generate profits. You can almost think of it like the company's report card. A higher ROE means it's an A student at making money with the money you invest. So, what's a good score on that report card? Well, as a general rule, for most companies, you want to see a consistent ROE of at least 10%. If you're looking at a bank or another financial firm, you want to set that bar a little higher, maybe around 12%. If a company can't consistently clear that hurdle, it's a pretty strong sign it might not be worth your time. Next up, growth. But here's the thing, it's not just about any growth. We want to see consistent growth. See, a company with smooth, predictable earnings growth year after year, that usually points to a really stable business that has some kind of strong competitive advantage. But on the other hand, if a company's earnings are all over the map, up one year, down the next, it makes them way harder to analyze and could be a sign of real trouble. And here's why that matters so much. That kind of erratic performance usually means one of two things. Either, one, the company is in a super cyclical industry, which isn't always bad if you know what you're getting into. Or two, and this is the more worrying one, it means they're constantly getting beaten up by their competitors. And for a long-term investor, that is a huge red flag. Okay, let's talk about cash. You've heard it before. Profit is great, but cash is king. So does the company consistently generate cash from its day-to-day operations? And even better, does it generate free cash flow? That's the cash that's left over after all the bills are paid and all the investments are made. A good benchmark to look for is free cash flow that's over 5% of its sales. But, and this is a big but, there's one major exception. It's totally okay for a company to have negative free cash flow if it's reinvesting that money wisely into high-return projects. Think about companies like Starbucks or Home Depot back in their big growth years.
So now we're going to shift gears a little from performance to risk. A company can look pretty good on the surface, right? So this step is all about digging a little deeper and looking for those red flags, the stuff that might be hiding in the details.
Debt. This is something you have to handle with care. If a company is carrying a lot of it, you need to ask yourself 3 really important questions. First, is the business stable enough to handle that debt, like a soap company or a food company? Second, is the debt load getting bigger or smaller over time? And finally, do you actually understand the debt? If you're reading the financial reports and they're full of all these complex instruments you can't even wrap your head around, honestly, it's probably best to just move on.
Here are 2 more big red flags to look out for. First, you want to be really wary of companies that are always reporting large, one-time charges. Come on, if it happens over and over, it's not a one-time thing, right? It can just be a way to hide bad performance. Second, keep a close eye on the number of shares outstanding. If that number is creeping up by more than about 2% a year, it means your personal ownership stake in the company is being watered down, usually because they're giving out tons of stock options to employees and executives.
Okay, so let's imagine a company makes it through all of these initial checks. What happens now? This brings us to a really important point. Passing this test does not mean you should buy the stock. It means, okay, now it's time to start your real homework.
A company that passes this test has earned its spot on your shortlist. But now, the real work begins. This means digging into the official filings, like reading the big annual report, the 10K, to really understand the business inside and out. You'll want to look at proxy statements to see how the executives are getting paid. You'll read through a decade of financial data to see the long-term trends, and check the latest quarterly reports for anything new. It's only after all of that heavy lifting that you should even start to think about what the stock might actually be worth.
And that brings us to our final and, I think, most important section, the path to discipline. This is where we really understand the true power of what this simple little test can do for your entire approach to investing. So here's the crucial takeaway. This 10-minute test, it's not just some random collection of questions. It is the essential first filter in a much bigger process. Its real power is that it forces you to be clear and disciplined. It pulls you away from all the market hype and emotional decisions and anchors your choices in solid evidence-based facts. It's the foundation you can use to build a scalable and repeatable process for yourself.
And this is really the bottom line. Think of this test as your personal gatekeeper. It makes sure that your most valuable asset, your time, is only spent analyzing companies that have a real shot. By making this screening test a core part of your routine, you are doing so much more than just finding stocks. You are systematically building the foundation for a more strategic, a more disciplined, and ultimately a more successful investment strategy for the long run.